it's Brad Laurie, or Blockchain Brad, and today we're speaking about all things IDEX. We had the CEO in the hot seat right now to let us know all about the updates, and this is entirely free on behalf of BlockBearer. It's all about providing truth on the blockchain and also key information as we start to continue to learn more about what each of these fundamental startups are doing for our space. So Alex, thank you very much for being here to let us know exactly what's going on.
Thank you, Brad. Appreciate you having me on the show.
Now, mate, obviously IDEX, prominent exchange, a lot of people know about it, a lot of people use it, but there's been recent updates of late, and I wanted to find out more about them. Can you tell us a little bit more, though, firstly, about what sets you apart in terms of decentralized exchanges, centralized exchanges, as we start to move forward towards 2020?
Absolutely. So I would imagine most of your viewers are probably familiar with the concept of a decentralized exchange. So cryptocurrency exchanges, the vast majority of them are centralized. And this term typically refers to fund custody, meaning when you deposit funds into the exchange, where do they go and who is in control of them? The vast majority of crypto exchanges like Binance and Coinbase, have a centralized custody solution, meaning you turn over control of the cryptocurrency in order to trade on their platform. Starting in maybe 2015, 2016, in particular with the launch of Ethereum, you started to see experimentation around decentralized exchanges. The goal here is to build the same type of exchange trading platform to allow users to buy and sell and trade with one another. However, to do so without requiring that they turn over control to that third party. So most of them, including IDEX, use smart contracts on Ethereum to implement this process. The idea being that the user can still create orders, trade against other users' orders. However, everything that requires movement of funds, so anything that actually swaps assets from one user to another, has to be explicitly approved by their wallet and their private key. So you get the same trading experience, but with a better security process.
Okay, so mate, obviously you've heard a lot about those who support the idea of a complete DEX as it's known, but then obviously some are arguing that, that could be just, perhaps a real ideal rather than something that is, sound in terms of making sure that you're performant, that you have top security, but you also can scale. So what are your thoughts when you hear someone say in the space, look, DEXs are the way to go. They're the exchanges we should be using, as opposed to those that have centralized aspects?
Yeah, so there's this great phrase that I like. It's from John Backus, and he calls it minimum viable decentralization. And the concept is to look at what are your goals as a product. If it requires decentralization to achieve those goals, how much decentralization, and basically build in that amount and then stop. Because decentralization is inherently inefficient, expensive, it adds friction to the process. So maybe just a brief story time here. Our first foray into the decentralized exchange space, my co-founder was working on what was known as EtherX. It was one of the earliest projects announced on Ethereum. It was a fully on-chain decentralized exchange, meaning all of the application, the order books, trade execution was managed by the Ethereum network. So it was fully decentralized in that it was more open. Anyone could access it simply by interacting with the Ethereum blockchain. There was no server that could crash or go down. However, it was also slow and expensive because each action required using the Ethereum network. So people have been iterating on this since then, and I think you're starting to see kind of a split in the market. So there's still some projects that have built upon kind of the early order book implementations like EtherX, and have come up with a cool approach, what's known as automated market making. So this is something like Uniswap, where there's actually essentially a formula in the smart contract that determines what price to offer each order. And users can actually interact directly with this contract in order to trade. You can think of it as the smart contract itself is the market maker and providing liquidity. And this is cool because it's a simple implementation conceptually. It minimizes the friction introduced by the blockchain because there's limited coordination required, but it maintains that openness. And then there's kind of the other direction, platforms like IDEX, where we're trying to maintain that what's known as a central limit order book, but the trade experience that most customers are familiar with, where you see the list of buys and the list of sells available. We're trying to maintain that UX while solving some of the issues of speed and cost associated with those early implementations. And we do that via a hybrid design where we have a balance of some components that are on-chain, mainly things that relate to the fund custody and security, and then everything else associated with the exchange itself is off-chain. So you can in some ways think of it as a centralized exchange with decentralized or smart contract-based custody.
Right. So, the best of both worlds in some respects without trying to shill you in any way. But let's talk about, though, the narrative we hear with DeFi in the space of exchanges, once again, to hark back to some of the, those diehard, supporters of, decentralized startups. What's the main value prop for you, moving forward to 2020 in terms of the tech, because you've been doing some significant updates as well, as I understand, bringing out demos as well for those to try and understand, more about how you're going to improve scalability, make more of this off-chain as well, especially in light of this push for more people to start to play around with decentralized exchanges.
Yeah, that's exactly right. So I think just to build on that idea that there's really kind of two markets emerging. So a lot of the DeFi is based on this idea of, it's called composability. And the concept is that one application can build on top of another application as kind of a building block. And in order to do that, you really need to be sure that that other application will always be available. It's never going to go down. You're never going to have your service be cut off, that sort of thing. So for those kind of use cases, something where it's a fully smart contract-based application is ideal, because you know that as long as the Ethereum network is running, you'll always be able to access that application as a building block. And then you have kind of the other direction, which at least for the short term is our focus at IDEX. It's about making an exchange that users are familiar with, that has the UX and performance that they demand. We really think that centralized exchanges are really, by and large, they're a killer application for cryptocurrency so far. It's got by far the most usage of anything blockchain related, and people by and large usually enjoy the trading experience. One of the glaring holes being the fund security risk. The fact that in order to trade on them, you have to turn over your custody to that operator.
Right.
So we're really focused on how can we make that UX that traders want while maintaining that fund security. And so you mentioned some of the developments we've been working on. Our first version, one of the big challenges was the cost of settling all of the trades to the network. So because we're sending each transaction one at a time for Ethereum to process, it can get pretty expensive. In 2018, IDEX users paid almost $5 million in gas fees to the Ethereum network to settle all their trades. This was almost 3% of what miners earned. So miners loved it, users not so much. So that's been our first big initiative, is to change the way we settle transactions and send them in batches rather than sending them one at a time. So we're able to do this through what's known as a layer 2 solution, where we do even more of the activity off-chain and then succinctly summarize that information and send it back to settlement on what's known as layer 1, or the main blockchain.
Right.
So this is just one example of one of the innovations that we're working on, with the ultimate goal of creating a direct competitor to these centralized exchanges that doesn't require you to use their custody solution and relinquish control in order to trade in that environment.
Right, and it is a big deal, because obviously us trusting you, in terms of custody, that's a big deal, and that's one of the reasons why so many people want to move to the DEX. Now, how do you really address this issue of security, as you start to make sure that you can improve the scalability? Because often there's trade-offs between the two. So, that's going to have to be fundamental, even beyond the scalability, is making sure that our assets are secure, utilizing your exchange.
100%. And I think that's why it's taking so long, right? This stuff is hard. And if you wanted to just make the UX, that you have centralized exchanges, right?
Yep.
But that the answer there is to give up on this decentralized fund custody. And, I think for one example, you can look at Binance and Binance DEX. They created their own decentralized exchange. However, it's seen limited adoption because they went the fully on-chain route. This is my opinion, of course, but what they essentially did was took a better maybe a faster and more performant blockchain in the form of Binance Chain, but built the same kind of implementation as some of those early Ethereum DEXs, where all orders and trades are on the blockchain. So the issue being that you have to pay anytime you want to do an action, and updates are slow because you're waiting for the miners to come to consensus on those actions, which is just not a great experience for trading. So really that's what it's all about. Like, as you said, you have to keep security front and center, because otherwise what's the point, right?
Exactly,
if you're not doing it for security reasons, then you might as well just centralize all of the application. Right. And then another kind of maybe just point about the security is it's really not only just keeping the funds safe, but actually giving users the flexibility to interact with one another regardless of what their custody solution is. So we want to enable users from hardware wallets, people who use a ledger or a Trezor, all the way up to large custody solutions, large institutional custodians, to be able to interact and trade with one another. And that's really more in line with the ethos of the kind of blockchain movement itself, right? Is these decentralized assets should have a decentralized method of custody and security.
Exactly. And how are the numbers going in terms of uptake as well for your exchange? Because obviously you mentioned there are competitors out there as well, Alex, but you also have a pretty strong reputation. You've had that for some time now. Is there an increase, even despite this current bear market, in the use and interaction with your exchange?
Yeah, so we see, at least with the current product, that our volume and usage tends to track pretty closely to the broader crypto market, which to me says we haven't done a good enough job really differentiating ourselves, right? So we offer a better security experience, but we're still, at least in this current version, we're asking users to sacrifice some on the UX. So it's safer, but there's many trading either properties, many trading products, or maybe trading features that we still haven't built into the application. So our goal is really to, over time, kind of get parity with these centralized exchanges. And this next version does a great job doing so on both the UX and the cost perspective. So it feels just like a centralized exchange, and there's no additional network cost to settle all of your transactions, even though you're doing so in a non-custodial way.
Right.
But as I mentioned, this is kind of an iterative process. One of the things that we still don't have a great solution for in the decentralized exchange space is Bitcoin integration. There's been some things, what's known as wrapped Bitcoin, which you can think of as basically Tether for Bitcoin. So BitGo holds on to the Bitcoin itself, creates an ERC or an Ethereum token version that can be tradable on DEXs. But it's really not quite the same thing as having a direct integration with the Bitcoin blockchain.
Yeah, and it also requires one extra layer of trust.
Exactly. And we want no trust. We want no trust to be required. So it's a kind of a funny term. It's called trustless, which sounds bad. But the point is that the system should not require trust to operate. Right. The system should operate just based on the kind of game theory principles that tie all of the blockchain economics together.
Exactly, mate. And it does seem to be, given the empirical evidence, that many people aren't that concerned about a small amount of centralization, given that there's so many boons to having this kind of system you built in, which kind of is the best of both worlds in some respects, as you start to improve your scalability and start to improve that off-chain capacity as well, so that you can be faster and operate in a more performant fashion. But in terms of the competitors, I wanted to touch on that, because there must be a reason, even beyond the technology, as to why they are so successful. And in that context, have you analyzed some of the sort of the actors in the space, some of the concerning conduct, because that's definitely happening. And also, some of the disclosures with regard to things like volume and liquidity are just not accurate in some respects, depending on, which exchange you look at, depending on which, third party you use to analyze this data. So you're in a very difficult market in many respects, because it's not all clean.
100%. I mean, we kind of think that in that respect, this is a long-term market. This thing is, decades in the making. It's going to be those that are honest, that are working on great products that kind of treat their users right and do right by their customers. Those are going to be the ones that last. So, we were really intrigued by CoinMarketCap is trying to do a better job at portraying which exchanges are exchanges that users actually want to trade on. And they came up with the liquidity ranking, which is an alternative to volume, where they try to analyze how much liquidity is there on the order books. And IDEX, which is 100 something in quote unquote volume, is in the top 30 or 40 when it comes to liquidity. So, that to us was a big positive factor, that if you look at these products in the right way, you can actually start to see, some of you can start to kind of weed through, some of the noise there. Anytime I see an exchange that I've never heard of that is higher than Binance in volume or higher than BitMEX, it's kind of ridiculous. Everyone knows there's, a few, kind of top 5 big names. And when these new ones come out of nowhere, those that are in the industry know that it's not true, but you're right that it doesn't look good on the outside. And then you get these headlines like 95% of Bitcoin volume is faked. Which, maybe that's true if you look at CoinMarketCap, but there's a lot of other resources that are doing a good job to filter out that information. So I think it's really an industry-wide kind of perception thing that we all need to focus on if we want this industry to continue to mature and be taken more seriously from those who are not inside of it.
Well said, mate. And also there's the other issue of wash trading as well. And I wanted to get your feedback. Obviously, you have members analysing this kind of stuff going on in different exchange scenarios. And just on that point you mentioned before with regard to the way in which CoinMarketCap or perhaps CoinGecko or any of these are listing, some of them are doing a great job. But then you also see anomalies like, for example, HitBTC on CoinMarketCap in their ranking. Sometimes you question, why are they ranking so high? And once again, it harks back to doing the proper analysis, which no doubt you guys have done looking at these competitors. So is wash trading something that is a concern to you when we look at the more macro sort of perspective of crypto?
Yeah, so it is and it isn't. I think, and this is maybe something that is indicative of something that we in the space need to be better at. Like I was saying, I think those who've looked at it have come to conclusions and kind of dismiss it, and maybe don't pay enough attention to it because we take a quick glance and go, oh, that's not real, and move on to other things that we're working on, right? But for those that are just showing up, they might look at it and go, wow, this is a great new exchange. Look at all this volume. And then, they could get hurt as a new customer in the space. So, to your point, it is something that, is important, because as new people join, they need to have real information to make informed decisions. There's no reason to, kind of hurt the chances of winning someone over to being a fan of the space by giving them access to or pushing them in a direction that's going to hurt them as a consumer. Exactly,
mate. Now, in terms of you making money, producing revenue, obviously there's listing fees involved, and we've heard reports of very, very high fees from other competitors. And often that deters some of the legitimate startups because they just simply can't afford it if they haven't raised a lot of capital. So are you competitive in that respect? And are you transparent about the kinds of fees that you do charge?
Yeah, so we actually, for the longest time, didn't charge any sort of listing fee. And we also had an open listing policy. The goal was to make it possible for any product to join and be listed, because we didn't like the kind of gatekeeper effect that was coming from some of the centralized exchanges. There were a couple challenges with that. So one of them was we realized that being listed on IDEX meant something. It was somewhat of a brand endorsement, and we were lending our brand credibility to products that were being traded there. So we had to kind of reassess that and institute a screening process. So we go through a relatively thorough onboarding process where we meet the team, we Skype with them, we gather corporate documents, we do some diligence to make sure that this is a legitimate project and that we know who the individuals are behind it. And that's done a great job. Since we've done that, we haven't really seen any issues with projects that haven't held up their end of the bargain. The second thing is we realized that we were incurring a fair bit of costs on both that onboarding process as well as smart contract audits and legal review. So we do have a listing fee, but it's extremely small. It's a few $1,000s, and it's simply to help offset and cover some of those costs that we incur when we onboard teams.
I see, and that's good to know, because obviously, as I said, some of the lesser known teams who don't have a lot of capital, they are looking for credible exchange, liquidity. Obviously, they don't go and seek out the services directly sometimes, but it's good to know that there are these opportunities out there for such startups where they don't have, as I said, a lot of capital. But looking back, at the more macro level of exchanges and all the options there, sometimes we also hear reports of market making internally, from some exchanges, or there's reports of this kind of malconduct as well. So when companies list, we tend to see sometimes in crypto an influx in FOMO and attention and price movement, because the common sentiment is that exchanges, relate to more liquidity and thus more FOMO, and you can see the snowball effect. So do you know of anything going on with any exchanges that you can comment on where market making is also, a problem? Because there are reports of this. And what are your thoughts on this, given that you do have relatively clean name and a clean brand?
Yeah, so I don't know of any, you hear rumors, so I don't know of any exchanges specifically. I can say that, one of the interesting things is there's a misconception between, I think, market making and wash trading. Yep. So market making is something that happens in traditional finance and regulated markets. The idea is that if you're making a product available, you need to have buys and sells, bid and asks, available for customers to get in and out of the product. If you have a new project, a new blockchain, and you want people to join it and become a staker, become a validator, for example, they can't do that if they can't access the market, if they can't buy it, right? So just fundamentally, having market making is, I think, a good thing, because it helps with the distribution of these networks. It helps get a more equitable ownership structure. By and large, market making is a positive, right? It also helps eliminate some of these crazy situations where you see people lose money in an instant because there wasn't enough liquidity on the books, or right. They made an order that ended up being terribly unprofitable for them. There's then the more some of the skeptics in the industry have started thinking of market making, which is really wash trading and manipulation. And obviously, you don't want any of that. Right. So I think that's really the space where we take it pretty seriously. We have internal algorithms that we use to track that sort of stuff, look for suspicious behavior across accounts, and ban any of those users that we suspect are participating in those market manipulations.
I see. And Alex, with respect to teams as well, because you mentioned quite rightly that liquidity support and market making is quite common in exchanges, especially in traditional markets, but not so when it comes to startups. Would you also, if you saw any proof of startups, would you remove them from your listing if there was clear proof that they were engaging in this kind of conduct?
So we actually have delisted a few projects before that seemed to, we reached out to them. They assured us that their market maker would stop the behavior, and it didn't happen. So again, it goes back to the idea that things on IDEX are an extension of our brand, and we want customers to feel confident that they can trust what we've made available.
Got it. Now, the process to get listed, I really want to find out more about this, because it was great to hear that you're rigorous in the criteria and the assessment of each of these startups. But what's it like, going through this process, and how long does it take, and how rigorous is it actually as you start to assess those that are deemed worthy of being listed on IDEX?
Yeah, so maybe I'll put it this way: we get probably 40 to 50 applications a week from different projects.
That's a lot.
And we end up listing 1 or 2 projects a week. So if that's an indicator of how much is out there, how much, if we were, less scrupulous and wanted to just list whatever came our way, there's a lot that we push back on, because we just don't think that it's a good thing for our customers to be exposed to. And honestly,
so you're clearly not after the money in that respect, Alex, because a ratio of 1 to 40, that's substantial.
Yeah, about that. Yeah. And I think honestly, it's kind of frustrating. Like, this would be a great circumstance where if there was some other entity or approach to regulating this, because it's not great for, I'm sure there's been some projects that we haven't listed that are quality teams. I can guarantee you we've made a mistake, right? And so that's kind of frustrating, because we really want to give access to those who deserve it and prevent access from those who are just trying to make a quick buck and aren't actually trying to build something. And it's definitely an imperfect process, right? And then there's also the legal side as well. So, there's some projects that maybe we think it's a great project, but there's some elements that make us uncomfortable providing it in some of the jurisdictions that we serve. So, you know, it's definitely a messy system in the sense that everyone's, you know, really doing their best to try to work through all of this. But we've got a lot of structure around it, and we really try to make the best decisions possible.
Right. And, you know, obviously you, with the brand you have, you risk a lot by having any of these listed under you, because people would naturally imply or assume rather the quality of your brand, you know, with those that you choose to list. So the pressure's on you also to do that rigorous assessment and due diligence. Now, with regard to the tokens, this is a tough call because tokenomics or token modeling rather is a tough thing to do, you know, even today, to try and find those semblances of value and correlation between the startup and that token, you know, that anomalous utility token as it's known. And that's essentially what you're listing. You know, how confident are you in utility token modeling? Tough question, because we're not seeing a lot of empirical proof yet of that correlation with the growth of these startups.
Yeah, so I think it's interesting, maybe a couple comments there. So I think you're seeing teams start to, you know, 2017 was a time where there really didn't have to be any tie between the token design and the project for the price to move, right? It was, I think that can kind of only happen once. It was a kind of retail speculative frenzy, to put it lightly.
It was pretty crazy.
It was pretty crazy. So, you know, we have always taken kind of a cautious approach, and maybe I can kind of tell this through our own token. So we've been trying to understand how we can best utilize a token to galvanize our community, make the exchange safer, build some of the resources that make an exchange valuable, in particular liquidity and trading volume, while also giving users the ability to essentially have some upside in case that exchange succeeds, or in case that we're successful. And so we've designed the IDEX token as a staking token. So I mentioned early on that we have some new developments where we are bringing a lot of the activity off chain in terms of the settlement process. The IDEX stakers are now involved in actually auditing and reviewing that off-chain data to make sure that everything is correct. For this work that they're doing, IDEX stakers get paid 50% of the trade fees from the platform.
Wow.
So it becomes pretty clear.
How many are there now? How many stakers?
Yeah, so we have over 200 nodes that are live staking IDEX token and earning some of the trade fees from the exchange.
Wow, they must be happy with that.
Yeah, exactly. So it's a cool, you know, it's beneficial to the exchange. Like, that's first and foremost what we were trying to think of is, you know, there's some other processes that are staking, which, you know, maybe you just simply deposit it into a contract, but it's not actually doing anything. It's kind of a bit of a gimmick in order to then feel that they can justify giving back that revenue to customers. In this case, they're actually providing network security. So first and foremost, they're making the product better. Right. That's kind of the key initiative, is that there's things we couldn't do in order to, you know, I mentioned that our goal is to make the most high performant, user friendly exchange while still keeping this decentralized fund custody. And the design that we've landed on requires a network that helps us do that process. It needs to be decentralized, and there needs to be incentives for them to participate. And so that's where the fee structure comes into play. So they get 50% of the trade fees from the platform as a revenue stream in order to incentivize that process and incentivize that security model. So I think you're going to start to see, so I think you're going to start to see more things like this, right? Like, there's a clear, direct value that these, you know, it's almost like mining, in the sense that if they do this work, if they lend their computing power, they're then able to earn these rewards that come from the network. In this case, this being a network of traders and market participants. And
you raise a really good point, because the utility token, by and large, is really an incentive or a reward for actual work being done. Despite, you know, we reference staking, it's still definitely doing the function of securing networks or other core roles and jobs that need to be done. And that harks back to, you know, traditional concepts of utility. We see the likes of loyalty programs, and each of those have their own core functions. So the interesting thing is that these new models, these new monetary models of utility token really do have the potential to have and assert utility. But there are also those that criticize and say, look, you don't need one. You know, why does an exchange need a token at all? We look at Binance, for example, we see that burn model, a lot of criticism about burning itself. So what are your responses to some of that criticism with regard to, you know, having a token? Because some would argue that it also is a means of, you know, capital raising, some say, or just really trying to, you know, assert some sort of monetary value for the exchange.
Yeah, so I actually think that, you know, the buy and burn is a great thing to discuss, because I think a lot of the criticisms are valid, and the analogy goes back to stock buybacks. And you know, they say that that if you're familiar with the concept of a stock buyback, the executives, the management, directors can take some of the profits, the income from the operation, and use it to purchase back some of the stock and essentially pull that stock out of circulation. Right. The idea is that the business is still just as profitable and generating just as much revenue as before the stock buyback. However, there's now less shares that own that business. So each share is now more valuable, right? So the pie stayed the same. However, the number of slices has shrunk, meaning each slice actually got bigger. Right. So that's kind of the analogy for why token buy and burn would be the same sort of thing. You start with a supply of tokens, you start to buy them back over time, and you expect that the price will go up because everyone has a slightly larger piece of the pie, even if their actual real number of tokens is unchanged.
And Alex, just to interrupt there, I wanted to ask you, and please keep going on this, but on that note, I wanted to ask you about the risks of doing that, because if you are essentially reducing the circulating supply, for example, or the opportunity for more of these tokens to operate as a utility, surely it begs the question of utility itself, if the agenda is to burn them.
It's a great point, right? And I think it kind of gets to, you know, what a potential conclusion is here, which is that there isn't really necessarily utility just from this one function. Meaning, just because it's getting more scarce doesn't mean it actually has value. And I think to kind of see that, just think of, okay, now what if they just stop buy and burn altogether, and they just say, okay, we're done, we're never buying anymore. What's going to happen to the value of that token? Like, is there other mechanisms? Are there other driving factors that make it so that people want to hold and want to use that token?
I think you raised such an important question, and I'm not going to say too much on some other assets I'm thinking of in that question, because that would be, you know, a very controversial sort of innuendo. But really, what you're saying is it's got to be more than just a burn model. It's got to have actual proven utility, and it's got to do something. And in your case,
that's exactly right.
Yeah. Okay.
Exactly.
So that's
and so, yeah, in our case, it allows you to operate this node, which, as long as the exchange is going, you're going to continue to earn some of the trade fees from the platform.
Right.
So, and you actually have a role in making sure it continues to operate through the security that you provide.
Right. So how did you come up with your overall metrics and the design of this token? Because you mentioned scarcity, and almost every token has that, you know, our finite supply, for example. How did you work all of that out with the team to make sure that you have enough tokens as you start to really scale and demonstrate empirically that there's utility, especially with the nodes that you have, the validators?
Yeah. So we've taken an alternative approach where we've been relatively judicious in terms of distributing the network, because we know that this is a marathon, not a sprint. You saw a lot of projects that sold 80% of the token supply in a large ICO. They ended up with, rather than a bunch of users, a bunch of speculators, people that had no loyalty to the project, and most of those did not end up very well. Right. So we took an alternative. A lot of whales, exactly. A lot of whales that can then, you know, manipulate the price.
Especially when it's a very scarce, you know, amount. We found, you know, looking at different coins, is that a whale will really look to those kinds of low total supply scenarios, so they can capitalize and really dominate the market with enough, you know, a collective of whales, for example. So what have you done to combat that stuff?
So a lot of it's been around making sure that we're distributing supply slowly. So we started with a 10% of the supply airdrop on members of our community. we have a couple different programs by which we distribute it. So one was a trading rewards program that we're currently kind of reworking to make sure that it's as effective as possible. But the idea is that as you trade, as you bring liquidity to the exchange, which you can think of this as another resource, right? Like what makes an exchange valuable? It's that there's market participants, in particular market making and liquidity, so that others can come and buy and sell when they need. So if you do that, we're rewarding you with tokens. We're also looking at potentially other kind of business development partnerships where you'll be able to, maybe if you bring a large custodian and integrate with the platform, you're going to want to know that your funds are secure, that your customers' funds are secure. That integration provides value because it's a big on-ramp for new customers. So we're looking at those types of programs where we could have a grant of a node. One other one that's pretty cool, so we're doing with the launch of our new demo, it's at demo.idex.io, excuse me, we're also running a trading competition. The idea is we want to get users to come test out the demo, help us stress test it in terms of performance. We've got over 5,000 users signed up, and the grand prize is 1% of the token supply as a staking node that you get to operate for 1 year. So the users will have an opportunity to learn how to stake, and they'll actually be one of the largest stakers in the entire network. And the goal there is to get people to participate in the competition, help us with stress testing the system, bug hunting, all those things that you need more participants to be involved in, while at the same time giving them a pretty cool reward and incentive to participate.
I think that's a good thing because there's not enough rewards, I think, for those that are doing these kinds of sort of dev-like, activities, those that are putting the time in to help you improve your own technology, essentially. Often we see other parties, like more the influencer side, being rewarded heavily, for different, for promoting rather than, tweaking tech. So it's a good thing potentially in that respect. Now, what about the actual listing number you have? How many are on the books in terms of offerings of different startups in terms of tokens as well? And are they all utility tokens currently?
Yeah, so we have a few hundred tokens available. The question about utility tokens, I think it's very interesting because that definition changes by jurisdiction.
It does.
So one thing worth mentioning to answer that, in the US, we have a very short list of available assets, about 15 assets that are available to customers. And you'll find that it matches a lot of the lists of other companies, other centralized exchanges that have a US and non-US product offering. And that's simply because there's different regulatory structures that people are trying to fit into. And maybe that, just to talk on that real quick, it's an interesting challenge because the internet obviously is a global resource. A website can be accessed from anywhere unless you start putting in prevention measures to block people from certain jurisdictions. And rules and laws in one area start to impact the user experience of customers in others. So it's definitely been something that maybe I didn't anticipate as much at the outset, but has certainly been an important part of the journey and understanding how best to operate this.
Okay, so clearly the numbers are different depending on which region. We've seen the likes of Binance do this as well. They have a very limited number on offer. When you look at other startups like Wearn, for example, when you look at their exchange and you see the kinds of listings they have, is there a correlation at all, do you find? For example, with your listings in the US? I ask because I do sometimes wonder, are there alliances among exchanges or among VCs with some exchanges? Because, for example, in Silicon Valley, they definitely talk. The VCs do talk to each other and they're aware of different investments they make. And sometimes we do see correlations very loosely, perhaps, with some of the exchanges, in that region as well. So what are your thoughts on that? Does it happen? And is IDEX, open to discussions of what others are doing? What does happen behind the scenes?
Yeah, so we're not part of any formal alliances. There was I forget who was participating, but I think it was Circle, Coinbase, Kraken, that attempted to release some ratings that were grading different applications based on certain characteristics. And I mean, the reality is you can look at all these different projects and, depending on what area you focus on, it might be a thumbs up or a thumbs down, right? So it's very difficult to pin these sort of things down. I think one of the things is people are kind of looking at which projects are available for longer, kind of how regulators kind of hinted towards certain things. The SEC, for example, has hinted that they would have viewed Ethereum as a security at the time that it launched, but that they now no longer consider it a security. So through these kind of, somewhat cryptic announcements and guidances, people are starting to try and figure out where the line is. And there's certainly an element of, watching what everyone else is doing in the space and, kind of taking cues from what they are doing. Because, we have a smaller team, we have legal counsel, but certainly not the size of something like Coinbase. So their public-facing decisions is a way to get some insights into what conversations may have been happening behind the scenes.
Well, that's good to know, because as I mentioned before, I do suspect there is some alliances had between some VCs and certain, exchanges. And obviously that's going to come more to light just with patterns, of listings related to investments. But moving back to, a focus on you and what is for the future, do you think that securities, for example, are going to be popular at some stage with dividends, given that right now there's still, as you quite rightly mentioned, a bit of a question mark even in classification of many of these, from commodity to utility, and now the suggestion of securities, perhaps because, once again, you have an equity holding, you have something that is part of a direct correlation with that team and that tech's potential in the future. Many people feel a little bit nervous, I think, about what a utility token constitutes, because, once again, of that overlap between its start potentially as a security or as I like to call pre-utility, and then move on to something that has more proof. So what are your thoughts on the evolution of classifications as we move forward?
Yeah, a couple of thoughts. So I do think that security tokens will become more popular here in the future. The reality is that it takes some time to work through a lot of the different either regulatory structures, the different rules. There's a bit of a adverse selection problem in terms of what's being tokenized. The concept being that many projects or many companies that are already successful and have the ability to list on something like NASDAQ and do an IPO probably aren't interested in this experimental tokenization route, right? So you're going to have to build up over time as more and more kind of the quality of those assets grows. I think there will be interest from customers, because going back to the utility model, I think some utility tokens have shied away from maybe more obvious methods of value accrual for fear of being labeled a security. I also do think that there's an opportunity to look at, and I really don't know what the answer is, because regulators will have you say, well, if it has some of the characteristics of a security, it needs to be registered and regulated as such. But I think that that's really missing the opportunity that the global digitally native kind of component of some of these assets allows to unlock. Meaning, if people are able to send it from one user to another, directly from one wallet to another, that's a pretty cool functionality that can unlock a lot of interesting use cases in UX, but is very difficult to have comply with some of the securities laws, which require, for example, a regulated transfer agent to manage that process. And so I think this is going to be part of building it out, is just getting regulators comfortable with, is like, well, what is the alternative to satisfy your concern, which is really ultimately investor protection? How can we satisfy your primary concern without requiring just all of these existing systems to be directly replicated in a blockchain environment? Because I think doing so, it's going to have a lot of friction. And I think honestly, that's a lot of what held back the first round of security tokens, was they realized that if you still have to do every single thing required of the traditional securities world,
then what's the point?
The blockchain doesn't add, exactly. It does. You're really unable to take advantage of a lot of the value that it brings, being basically internet native and digital.
Yes, and it does seem that those who are working towards these security or securitized assets that are utilizing blockchain, it does seem that they're working hard with regulators at the moment, trying to really educate them on the benefits of this, particularly in light of SMEs, for example, who simply just cannot access that traditional marketplace because of cost and many other factors. So there does seem to be a lot of potential, but we're still so early. and I'm sure you would agree, you know, there's a lot of potential for things to move forward. But what about the future of IDEX as well? I mean, how do you see things moving forward, given that there's in various regions, especially in Asia, there's just such a dominance, for example, in Singapore, with regard to regulation. They're very progressive when it comes to blockchain, a little bit less rigorous when it comes to, you know, the regulations as well. So, you know, how are you going to build? How are you going to really expand and become even more competitive in this tight marketplace?
Yeah, so I think, you know, it reflects in our corporate structure and our market structure, right? We have a US and a non-US component. Like many others, we were actually one of the first to do that, because I think we kind of correctly identified that you're seeing an opportunity for, I hate the word regulatory arbitrage, but you're seeing an opportunity for different products in different markets, because the laws are just different in different places. You know, so I think that's part of it. I think ultimately for us, it really comes down to how do you differentiate yourself amongst what is still hundreds of competing exchanges. And you've got a lot of great centralized exchanges that are competing to roll out different products. You've got a lot of decentralized exchanges that are focusing on, you know, how do we build some of this composable DeFi stuff? And we're really focused on, okay, how can we take our unique set of knowledge, you know, things that we've built up over the last couple of years as being the top decentralized exchange, take that to build something that can really go head to head with centralized competitors while having this differentiating factor of decentralized fund custody.
Exactly.
And that's really our guiding principle when it comes to product decisions: security first, UX second. And I think if people check out the new demo, the new version, they'll be pretty impressed with what we've built. You know, in some ways, it's the goal is to have it feel exactly like your centralized exchange. So customers might try it out and say, well, I don't get it. It feels like Binance. But that's actually quite difficult to achieve, and something that we're pretty proud of.
Well, Alex, you know, it's been such a privilege to be able to talk to you about all the things that you are building, because many people do know well and truly your brand, let's be honest, and many people do place trust in, you know, the trustless design of certain exchanges. But as you've mentioned, there are key boons and benefits to having that nuance and that aspect of centralization built into this sort of hybrid model. That's how I see you as you move forward. And obviously, you know, developing more, you know, improving that off-chain capacity, making sure that you're showcasing development through these demos. I'll make sure that they're in the links below. But thank you for updating us. Thank you for letting us know exactly what you're doing, how your process of assessing different startups is, letting us know what's listing and the differentiations of jurisdictions as well. But mate, is there anything I've missed in terms of covering what you represent as a brand, as a startup, what you're actually really about and what you're building, so that you really get a chance to let people know that you're here for the long haul?
No, this was great. I really appreciate the time. Like I said, the best thing you can do as a viewer is go check out our demo and come participate in the competition. I think you'll see that you know, we're making great strides to building an application that gives you the centralized exchange experience that you demand, but doesn't require that you give up custody and give up security of your funds in order to participate.
Well said, mate. This is Alex Wearn. He is the CEO of IDEX. Thank you very much for your time today. I do really appreciate that. And hopefully, mate, we can catch up sometime in the future and just focus on, you know, perhaps some of these developments, key aspects, especially when it comes to the off-chain developments and scalability of what you're doing, so that, you know, as your technology improves, as the user experience improves, we can catch up and talk about, you know, the success of everything as you move forward. So I do wish you all the best. This was entirely free, so there's no payment involved, there's no sponsorship, none of that. This is about letting people know when teams work hard and they're trying to do the best they can to try and give you the best user experience, give you transparency, they deserve at least a platform to explain themselves as they continue forward. So keep going, mate, keep building, and I wish you all the very best.
Awesome. Thank you, Brad. Appreciate the time.
You're welcome, mate.